Welcome to the BFM batch. Okay. Yeah. So now this is for this November. Hi Neelam. Evening. This is for the November batch. Okay. November 23 coming up. Chalo. Let's start. Okay. Without wasting the time, we will start it. Okay. So yeah, the first topic of ours is basically exchange rates. This is on in module A, exchange rates. Okay. So what we'll do is we'll go step by step. We have an ample time now. Okay. And all our portion will be completed. Everyone be rest assured that whatever is asked in the exam is completed in our classes over here. Those who are watching on YouTube for the first time, again, the free series is available for 1 or 2 days. Then you will have the paid series. Okay. So join the batches ASAP. Okay. So see this. Immediately we'll start the module A. Factors determining the exchange rates. What are the factors which determine the firstly what do you mean by exchange rates? Exchange means what? Exchange means exchange of one currency to another. Dollar versus rupee, that is the exchange rate. Rupee versus rupee is not the exchange rate. Dollar versus dollar is not the exchange rate. Exchange is when one commodity is exchanged against the other. Then only it's called as exchange. If same commodity is exchanged, it's not an exchange, it's simply a transfer of money. Okay. So what affects these exchange rates? So this exchange rates are affected by two types of factors. One is long term, we call it fundamental factors, and second is short term. Okay. Long term factors are which? Long term factors means those factors. Okay, firstly, everyone, I have shared the PDF over here in the pinned comment. Kindly download that PDF. That is a handout for today. You can watch it, read it also, and always keep the handouts which I am giving it to you. Because I'll tell you, this time's paper, May 23 paper, was majorly from the handouts. Okay, so that's why follow the handouts very seriously. May 23, if you ask the paper, it was majorly from the handouts. Okay, so everyone download those handouts immediately. I've shared it over here. Okay, also I'll be sharing it in the Adda app also, so you can watch it there also. Okay, so what are the fundamental factors? Fundamental means long-term factors. Long-term means which goes slowly. Means what? Balance of payment, economic growth rate, fiscal policy, monetary policy. These are all the long-term factors. Now, balance of payment means what? There are two things always. Okay. One is balance of trade and second is balance of payment. See this, I have written it over here. Balance of trade and balance of payment. Hold on, I'll show you. See this. This is balance of trade, this is balance of payment. Understand the difference between balance of trade and balance of payment. Okay. Trade means what? Trade means business. Payment means what? Remaining, everything, non-business. Okay. It's like simply the current account and saving account which we have in our banks. Same logic. Balance of trade is like the current account. Balance of payment is like the savings account. Okay. In savings account, do we do the business? No. In current account, we do the business. So that's why import export will be a part of balance of trade. Okay. Balance of payment remaining. All this FDI coming in, FPI coming in, NRI funds coming in, ECBs coming in. These will all be a part of BOP, balance of payment. Understand one thing, if you give something and take something, then it is trade. Only if you get the money from outside, then it's not trade. So that will come under BOP. Okay. So now, always remember current account, the net of current account. Suppose if I am the proprietor of any firm and I am having the current account with any bank. So whatever is remaining on the 31st March in that current account, after all my expenses are gone, everything gone. So whatever remains is my money, owner's money. So that money will be always transferred to the savings account in the end, right? Because after all, it's my money. So same thing happens with BOT, BOP also. In balance of trade, the net of balance of trade will always be transferred to balance of payment. Always remember this. Net of balance of trade will always be transferred to balance of payment. Rupee is fully convertible in balance of trade, but it is partially convertible in balance of payment. Always remember this term. Rupee is fully convertible in balance of trade, but partially convertible in balance of payment. Okay. So now coming back, balance of payment done, economic growth rate. A higher growth rate leads to rise in imports and fall in the value of the currency and vice versa. This every time the same thing happens. Remember, leads to rise in imports. मतलब import जो है in the short term. Now here we are talking of a short term. Remember, here if my growth rate is higher, this will lead to rise in imports in the short term, and in the long term, it will lead to the rise in exports. Long term, it will always be exports. Okay. So if my imports rise, my currency value of the currency will fall. If my exports rise, the value of the currency will rise. Fiscal policy, an expansionary policy, lower taxes can lead to higher economic growth. So now remember, fiscal policy can be expansionary, can be contractionary. Similarly, monetary policy can also be expansionary or contractionary. The way central bank attempts to influence and control interest and monetary money supply can impact the value of the currency in the country. Here, both the policies, fiscal and monetary, can be expansionary, expansion, okay, or contractionary, contraction, okay. Both can be the same. When my fiscal policy is given by Government of India. When my fiscal policy is expansionary, when it is in the expansion mode, government will reduce the taxes, lower the taxes. If government wants to expand any economy, it will always reduce the taxes. If RBI wants to expand the economy, it will always reduce the repo rate. Always remember. Now vice versa is also true. If government wants to contract any economy, then it will increase the taxes. Similarly, monetary policy. If RBI wants to contract any economy, it will increase the repo rate. Okay. So these things affect the exchange or exchange of any currency in the long run. Now, interest rates. Higher the domestic interest rate tend to attract higher overseas capital. Thus, capital appreciates in the long term, in the short term. It means what? If the interest rates in any country are higher, then funds tend to flow towards that country. If you look at the October to December 2022, USA was on the increasing spree. Means USA was going on increasing the rates of their basic rates, repo rates. So that's why what happened? Complete funds from all over the world stock market moved to US. Okay. So in the longer term, however, higher interest rates slow the economy down, thus weakening the currency. Okay. So that's why remember, interest rates, interest rate means basically they are talking of repo rates. So if my repo rates go down, my GDP will always increase. But if my GDP will increase, my inflation will also increase. Remember, see this basic logic behind this, always remember the interest rate logic. If interest rate goes up, interest rate means basically we are talking of repo rates. Here, benchmark rates we call it repo. Okay. So if my repo goes up, my GDP goes down, my inflation goes down. Okay. Always remember this. Repo up, GDP down, inflation down. Inflation down is good for the economy, but GDP down is bad for the economy. Okay. So political issues. Political stability is likely to lead the economic stability. Hence, steady currency, while political instability will have the opposite effect. So, political instability will always have, देखिए, in any country, like suppose if I ask you to invest in, let's say, Sri Lanka, will you invest? No, because there is political instability. Every 1 year, the government changes in Sri Lanka. Similarly, in Pakistan, if I tell you to invest, you won't invest because there is a political instability. Afghanistan, you won't invest. Instability. So, political issues will always affect the country's currency in the long run. Political stability is likely to lead the economic stability, hence steady currency, while political instability will have the opposite, right? So what is pestle analysis? ये आपको शायद आया था. It was there earlier also in one of the exams. What is pestle analysis? Right? Political, economic, social, technological, environmental, and legal. That is basically pestle analysis. While investing in any country, any financial institution will first check for the pestle analysis. Whether politically that country is stable, whether economically that country is stable, socially how is the structure of that country, whether the people over there are cooperative, they are ready to work, technologically how advanced this country is, environmental laws now, those have become very important now. Earlier they were not of that importance, but environment has become a major point now. Similarly, legal, what are the legal laws of that country? So that is also very important, legal. So that's a pestle analysis is done by each and every institution before investing in any country. So similarly, one second, yeah. Technical reasons. Now these are short-term reasons. Government controls can lead to unrealistic value of the currency, resulting in violent exchange rates. Means what? Suppose if government control, like in China, suppose if you look at China, it is totally controlled. The whole currency is controlled by the government in China. So government controls can lead to unrealistic value of the currency, resulting in violent exchange rates. Huge fluctuations. There was one period when China immediately in one night reduced this yuan currency by 7%. Some 7 years back, 6-7 years back. So that's why government in many of the socialist countries always try to intervene in the currency manipulation. Whereas in the capitalist economies like India is a mixed economy. It's not a capitalist economy. So in India, countries like India, RBI doesn't interfere directly in the market determination of the rates. RBI never goes directly in this. So government controls can lead to unrealistic value of the currency, resulting in violent exchange rates. Freedom or restriction on the capital movement can affect exchange rates to a larger extent. Capital tends to move from lower yielding to higher yielding currencies and results in movement in exchange rates. Now look at this. Lower yielding to higher yielding. Always remember the country which is giving lower rate of interest, whereas the country which is giving higher rate of interest. Funds will always flow from low rate to higher rate. In your banking also, suppose if in our bank we are giving the lesser rate for the FD, people won't stick to us. People will jump to the other bank. Okay? Speculative forces can have a major effect on the exchange rates. In an expectation that the currency will be devalued, speculator will short sell the currency for buying it back at a cheaper at a later date. Now, what do you mean by speculative forces? Speculative means basically the middleman. Always remember, the middleman is known as the speculator, means generally the brokers which we have. Brokers in any country or any currency or any market will always try to speculate the rate. Now, speculate the rate means what? They always try to manipulate the rate. Okay? So, manipulation of rate, speculative forces can have major effect on the exchange rates. In an expectation that a currency will be devalued, speculator will short sell the currency and buy it at a lower rate later. Now, what do you mean by short selling? Understand this part also. Short sell means what? See, here, there are two positions always in any forex market or any commodity market. There are two positions. One is long and second is short. Okay? What is long position? Long means I buy now, buy now, and then I sell later. Sell later. That is known as long. And then what is short position then? It's the reverse. I'll sell now, and then I'll buy later. Buy later. Okay? So when will I follow this above policy or when will I follow the short policy? Here, long policy is always followed when I expect the rate to go up. Why do you buy a land in your wherever you stay, right? We always try to buy one flat extra. So giving it on rent, later that rate of that flat will increase. Why? That is known as long position. It means I am buying that flat now with the expectation that it will go at a higher rate some days later. Now, what does this mean? Suppose if tomorrow the rate of the flat you come to know that it will be going down. So will you invest in that flat? No one. Suppose if I tell you this Reliance share is going to go down, will you invest in the Reliance share? No. So everyone follows a long position when that person expects the rate of that commodity to go up in the future. If I tell you today that Reliance share is now at 2500 and tomorrow or within 1 week it will go to 2000. Suppose if I tell you that, what will you do? You'll always try to sell now because it's now 2500 and after 1 week you'll be getting it at 2000. So what you'll try to do, you'll always try to sell that Reliance now and buy it later. So that is known as short selling. I don't have that commodity, but then also I sell it. Virtual commodity I sell it. And then I square it off. Square it off means buy it later at a lower rate. So I sell at 2500 now and buy at 2000 later. So that is known as short selling. Okay. Now some questions for you. The term foreign exchange is used to denote dash as well as the dash of one currency into another. Look at the answer. The term foreign currency used to denote foreign currency. Means when I say dollar, it means I am dealing with foreign exchange. As well as the dash of one currency into another, exchange. Whenever I say I have to exchange dollar for rupees or rupees for dollar, it means what? It means I am dealing in exchange. So foreign exchange means currency to currency. Okay. Now it can exchange. If I remove this word forex from here, foreign exchange from here, then exchange can be with anything, oil, gold, dollar, anything. But when I say foreign exchange, it means it's strictly between the currencies. Okay. The exchange rates for major currencies fluctuate every dash seconds. Now this, let me remove the answers which I am having it over here. Hold on. So, the exchange rates of major currencies fluctuate every dash seconds. So, the answer for here is 4 seconds. Remember this, okay? Now, state true or false. Now, this is what you have to answer. The forex markets are dynamic and round-the-clock markets. True or false? Everyone answer this, whether it's true or false. Forex markets are dynamic and round the clock markets. True or false? Correct? Correct, Neelam. It is true. Very good. True. Okay? True. Forex markets are not affected by government policies. True or false? Second one. Second one. Forex markets are not affected by government policies. Is it true or false? False. Correct. It's false. Okay. They are affected. Means what? For example, let's look at this Pakistan. Right? Pakistan forex rates are definitely affecting their this rupee, right? Similarly, Afghanistan, Sri Lanka, everywhere, all our neighbors. Just check it. Large part of the total global forex turnover results from global commodity trade. So, large part of global trade forex results from global commodities trade. Is it so? True or false? Forex turnover is a part of the because of global commodities, means oil and this everything. It's not that. Okay, the answer is false. Answer is false. Okay, so this global forex turnover is not because of the global commodities. Remember, it's because of the individuals who deal with the forex. Okay. Now, those who are watching on YouTube, kindly subscribe to Officers Adda 24/7 YouTube channel. Right now, you are watching this on this freely, but later, after 1 or 2 classes, you won't get it free. Okay, so subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CAIIB. Plus, you'll be getting the free YouTube series on all the subjects of JIB and CIB. Plus, you'll be getting the marathons. So that's why subscribe to the channel, click on the bell icon immediately. Okay? Chalo, let's move on. It is done. This is done by us. Yeah. Now this part. Okay? What do you mean by this forex, cash, Tom, everything? Now look at this. Most of the forex deals are done on spot basis, meaning thereby that the delivery of funds takes place on the second working day. Now, whatever I am telling you, pay attention to this. Spot means second working day. Whereas others, we also have cash ready position. Cash ready means same day. Means what? Suppose let's say I buy some grocery, okay, sabji, vegetables. I buy vegetables, okay, and pay the money. See here, two things are there. One is vegetable, second is money, right? So suppose if I buy the vegetables today and give the money right now only, so it is known as cash ready. If I buy the vegetables today and tell the shopkeeper, that's it, tomorrow I'll be giving you the money. So that is Tom. Spot. I'll buy the vegetables today and then I'll tell the shopkeeper that see, I'll be giving the funds day after tomorrow. So next to next working day. So that is spot. But if I tell the shopkeeper that see, give me the vegetables today, I'll be paying you after second working day. Means next week, next to next week. So that is known as forward. Okay, forward means any day after spot. Spot means next to next working day, means second working day, you can call it second. Okay, Tom means next working day and cash means same day. Now there was one question in this time also in BFM. This time there was a question on this. The question was, if today I have done some transaction and I have done the transaction on Tom basis. Tomorrow is a holiday. Then when will my Tom happen? When will my settlement happen? So if I have done the transaction today and tomorrow is holiday, then my Tom happens day after tomorrow. Working day. Remember this. It is working day. Okay? Yeah. This time also there was a question on this. Yeah. Always remember there will be a question on this part in your exam. Now tell me one thing. Always remember Saturday and Sunday. Saturday and Sunday are holidays in forex market. Holidays. Okay. So now tell me. Suppose if I do some transaction on Friday. Friday. When will I have my Tom? When will I have my Tom? So Tom will be when? Tom. Friday's Tom will be? When is the next working day? Correct? It will be on Monday. Correct. It will be on Monday. Monday. If Monday is a holiday, suppose let's say this Monday is a holiday, then in case Monday is a holiday, then the Tom will be on Tuesday. Okay? So next working day. Now tell me, if I have done the transaction on Friday, when will be my spot? When will be my spot? If I have done the transaction on Friday, who can tell me? If I have done the transaction on Friday, when will be my spot? My spot will be on Tuesday, correct? It will be on Tuesday. Okay? When will be my cash position? Cash. Cash will be on Friday itself. Cash and ready. It will be on Friday itself. Correct. Spot will be on Tuesday. Correct. When will be my forward? When will be my forward? My forward will be any day after Tuesday. Any day after Tuesday. It means it can be Wednesday also, it can be Thursday also, it can be next year also. It can be next to next year, 2 years later also. So forward can be anything after the spot. Okay. So what is future then? What is the difference between future and forward? So future and forward means future is organized forward. Always remember, future is organized forward. What do you mean by this? Organized forward. Organized forward means, look at this. Future is organized forward. It means what? It means that whenever, suppose if I am dealing with only two customers, say this. In forward always there are two parties. Okay? And in future there are always three parties. Okay? Here the two parties are buyer and seller. Buyer and seller. Okay? Here the three parties are buyer, seller and exchange. Exchange is there in between. Okay? Suppose if I ask you one question. Suppose if tomorrow you buy some shares. Okay? Any company shares. So do you ever come to know who is the seller of those shares? Suppose if you buy some shares today. Okay? So do you ever come to know who is the seller of those shares? You don't know. Right? You'll never know. Why? Because there is an exchange in between. What does that exchange do? That exchange plays the role as a settlement exchange. Settlement. Here the exchange covers the settlement risk. Always remember, settlement means what? Settlement risk means risk. Okay? What do you mean by settlement risk? Settlement risk means, suppose if there are, see this in forward. Okay? There are two parties, buyer and seller. Suppose if the seller says, I'll sell you the goods and he takes money, but it never sells, then who will control that risk? Whereas the reverse case is also true. Buyer buys the goods but never pays. So that's why here, whenever we are dealing with future, there is an exchange in between. Exchange will cover this risk of seller not giving the goods or buyer not giving the money. That is known as settlement. So future is known as the organized forward. Okay? The date of delivery of funds on the date on which the exchange of currencies actually takes place is referred to as value date. Now there are 2-3 dates in any commodity exchange, commodity market. Always remember. One is the transaction date, transaction TRXN, I'll write it. And second is the settlement date. Okay. So the difference between these two will always decide whether it's cash, term, spot or forward. If transaction and settlement are done on the same day, then it's cash. And it goes on. Settlement for the next day, term, next to next day, the spot, and forward is afterwards. Okay. Forward rates are derived from the spot rates and are the functions of spot rates and forward premium or discount of the currency being quoted. Forward rate equals to spot plus premium or minus discount. Now understand this. This will be very useful to you in while solving the numericals. We will have the numericals in next 2 to 3 days. Not tomorrow, I don't think so it will be there. But after 2 days, we'll be having the numericals. Okay. So always remember, forward rates are taken when we have the spot rates plus premium, or when we have spot rate minus discount. Discount will always be subtracted. Premium will always be added. Now let's look at one example. Now this is spot rate is given as 80.2333. So this is my rate of spot. Okay, 80.2333. Spot means what? Today's rate. So this left side is known as bid or buy. Right side is known as offer or sell. This, it means what? Any bank which is giving this rate of 80.23, it means it is ready to buy at 80.23. And whenever it's giving the rate of 80.33, then it is actually ready to sell at this rate. So now what is premium and discount? When your right side is bigger and left side is smaller, it is known as a premium. Now one thing which I'll tell you, spot rates never decide premium or discount. Spot rates never decide premium or discount. Spot rates are just spot rates. If you have to decide on premium or discount, you have to decide on in the future forward rate. Forward rates are always given to you like this: 1 month 10-20. Now 10-20 means what? 20 is known as my sell rate and 10 is known as my buying rate. So left side is always buy, right side is always sell. Okay. So 1 month 10-20. 2 months is given as, look at this, 30-20. Now what does this mean? My right side is lower, left side is bigger. So my buy is bigger, sell is lower. So my currency is in discount. Whenever my right side is bigger and left side is lower, then my currency is in premium. Whenever my right side is smaller and left side is bigger, my currency is in discount. Okay. Now let's solve this numerical. Spot is given as 80.23 and 33. And what do I want? I want the buying rate after 1 month. Okay. I want the buying rate after 1 month. So if I want the buying rate after 1 month, how will I solve this? Say this. For 1 month, my currency is in premium. So 10-20. 20 means my right side is bigger. So it's in premium. So whenever my currency is in premium, I'll always add this. Whatever is my difference amount. Means this these points. Okay. So if I tell you to find the rate of the dollar after 1 month for buy, I want the buy rate for after 1 month for dollar. So how will I get it? 80.23, that is my spot, plus 10, 80.33. Look at this, 80.23 plus 10. So 80.33 I'm getting it. If I ask you the rate for the dollar for selling after 1 month, so I'll take the right side rate, 80.33 plus 20. So it is 80.53. Now look at this, whether it's buy or sell, if the currency is in premium, you will always add. Whereas for the 2 months, look at this 2 months rate. So 80.23 over here, but this currency is in discount, so I'll subtract it. let it be buy or let it be sell. I'll subtract it. So my rate for 80.23 after 2 months will be 80.23 minus 30. So it is 79.93. Correct, na? 93, this correct, yeah, 79.93. Similarly, my sell rate after 2 months will be 80.33 minus 20. So 80.13. Okay? Got it, everyone? Now I'll give you one question. Okay? Yeah. Now let's solve this. Now my spot rate is given as 80.2333. Let's keep this as the same. Now 3 months, my currency is given as, let's say, 50 and 40. 50 and 40. Okay. Now you guys give me the buying rate, buy rate after 3 months. Buy rate after 3 months. You give me the rate now. Everyone. You give me the rates for buy after 3 months. Who can give me? Those who are watching on YouTube also, you can also give me. Type in the comment section. What is the buy rate after 3 months? Correct, Neelam? Correct. What about others? Buy rate after 3 months. Yes? Neelam, you are right. 0.23 is just correct. So it will be 79.73. Say this, 79.73. Now if I want the sell rate after 3 months, sell rate after 3 months, so it will be sell rate after 3 months. Sell rate after 3 months. Everyone? Sell rate after 3 months is, who can give me? 79.93, correct. 79.93, correct. 79.93. So remember, one thing which I wanted to focus on this is, let it be buy or sell. If your currency is in discount, you will always subtract. And if your currency is in premium, you will always add for buy also, for sell also. Okay? Now forward rates are the function of spot and forward premium or discount. Now this is what I am telling you. Let's see this. Okay? Now this is very difficult to understand. If the value of the currency is more than being quoted on the spot, then it is said to be at a premium. While the currency is cheaper at a later date than spot, then it is called a discount. Means right now my, let's say the property, the flat which I have brought is, let's say, at 50 lakhs. Okay? And after 2 months or after 2 years, somebody is predicting that the value of that flat will be, let's say, 80 lakhs. Then my flat is at premium. And if somebody is predicting that after 2 years, the value of that flat will be 30 lakhs from 50 lakhs, then my flat is at discount. So whenever any commodity is trading at a higher rate in future market or forward market, so then my currency or that commodity is in premium. Whenever it's quoting at a lower rate in the forward market, then my commodity is in the discount. If the spot GBP against USD is being quoted at 1.6 and 1 month forward is being quoted at 1.6050, GBP is dearer. Value of 1 month forward as a premium of 50 this BPS is being charged on the same. Now what do you mean by this? Understand this very difficult. That's why I said this is a difficult thing to understand. Okay? Let me see if I'm having something over here. Look at this. Yeah. See this. What is given? GBP was first quoted at 1.6. 1 month forward is 1.6050. Now understand one thing. There are two types of rates. One is direct rate, second is indirect rate. Indirect. Okay. So whenever my SCR, everything depends on dollar. Okay, and a home currency. Suppose if my dollar is fluctuating, dollar is moving, okay, fluctuate, then that is known as direct rate. If my dollar is stable, okay, then that is known as my indirect rate. Always remember. Okay. So in direct rate, suppose if I consider rupees, dollar to rupees, so $1 equals to 80 rupees. Okay. So how do I quote dollar to rupees? So that is a direct rate now. In India, we use the direct rate system. Whereas GBP is always quoted in indirect rate system. It is always quoted as GBP to dollar. Dollar is in the denominator over here. And in direct rates, dollar is in the numerator. That is the difference between direct and indirect. Dollar will always be in the numerator in direct. Dollar will always be in the denominator in indirect. Okay. So if GBP is presently quoted at 1.6, so what does it mean? It means GBP to USD equals to 1.6 today. But after 1 month it is 1.6050. So who is growing? By 50 basis points, who is growing? This GBP is growing. So dollar is 1 only. Earlier also this was 1, now also 1. So who is growing? GBP. So GBP is dearer. Dearer means what? Dearer means in the premium. The currency which goes higher is known as dearer currency. Right? In our life also we have the same thing. The one person who grows is always liked by others, is always at premium. That person who does not grow or goes down will always be at a discount. People don't care for that person. So same thing is about dollars also, commodity also. Okay. So next, let's calculate this. The following are the interbank rates quoted. Look at this. The following are the interbank rates quoted in the foreign exchange market. Okay. Calculate the rates for inward remittance and outward remittance spot, assuming the margin of 10 paise over the interbank rate. Now understand this problem. Okay. Whenever you have to solve any numerical on Forex, you have to follow 3 steps. Always remember. Firstly, you have to decide, number 1, it is buy or sell. Buy or sell. Number 1. Okay, I'll write it over here. First, you have to decide on buy or sell. Buy, sell. Then second, you have to decide on forward margin. Forward, whether it's premium or discount. And third, you have to decide is the exchange margin, TT. Exchange margin, they call it. Exchange margin. Okay. So now, you have to follow these basic steps always. So now what is given? The interbank rates are quoted in the Forex market. The rates for inward and outward remittance we have to calculate for considering this 10 basis points. Now what is spot given? Spot is given as USD to INR equals to 75.0050 and 75.0075. So what is my buy rate from here? Suppose if I want to buy, so what will I quote in that buy rate? Okay. What will I quote in the buy rate? 75.0050 or 75 for buying. What will I quote? Correct, Pinaki? I will quote 75.0050. Correct. Yeah. 0050. Now tell me one thing. Everyone. Now I'll clear one misconception in your mind. Everyone is having this misconception in their mind. Okay, let me clarify that. Looking at this problem, Can you tell me the currency is in premium or discount? Looking at this problem, can you tell me the currency is in premium or discount? Dollar, let's say dollar. Dollar is in premium or discount? Who can tell me? Those who are watching on YouTube, you can also type. Who can tell me? The currency is in premium or discount? Let me clarify this point in your mind. Everyone, pay attention to whatever I am saying now. Pay attention, everyone. Okay? Always remember, currency can never be decided in premium or discount looking at the present spot rate. Spot rate will never decide the currency is in premium or in discount. Always premium or discount will be decided from the future rates, forward rates. Okay? So, suppose if I ask you today, okay, right now I ask you, see this, always pay attention everyone. Currency is always decided by the future rate, forward rates, whether it's in premium or discount, this 1 month, 15 days, whatever it is. Today's rates never decide the currency is in premium or discount. Suppose if you buy a flat today, let's say, everyone buys this flat today, okay? You buy a flat today for, let's say, 30 lakhs. Okay? You buy a flat today for, let's say, 30 lakhs. And I ask you, so you have a higher rate or lower rate? You'll say, no, it's a normal rate going on in the market. Suppose after 1 year, if I say that, okay, at what rate are you going to sell the flat? Suppose if I ask you today only, suppose if you buy a flat for 30 lakhs and you are planning to sell it after one year or 2 years. Why are you planning to sell? Because you feel that the rate of that flat, which I brought it at 30 lakhs, will go to around 50 lakhs. So always remember, any commodity is considered as at a premium or discount only looking at the forward rates. Spot rates never ever decide the currency premium or discount. Okay. So now what do we want? We want both inward and outward remittances. So let's work on inward first. In inward remittance, here, inward is always done for exports. Always here, I have marked it over here. Inward remittance is always for exports. Okay. And whenever I am having exports or inward remittance, I'll always buy that currency. Always remember, I'll buy. For exports, I'll always buy. Okay. So now, inward remittance, I'm working on this inward, so I'll be buying this. So what is the rate at which I'll be buying? 75.0050. Okay. I'll be buying at 75.0050 because that is the buy rate. But there is a margin given. What are the three margins I told you? Buy, sell first. Then second is forward margin. But there is nothing mentioned as forward over here. Everything which we are dealing is in spot. Today only. So this forward becomes 0. Now exchange margin. Exchange margin is given 10 paise over the interest rate, interbank rate. So 10 paise they have given. So now one thing you remember always, whenever I am buying, I'll be using buy low. Buy low means what? I'll be always try to subtract whatever this margin is. Okay, while buying. So 75.0050 minus, okay, 0.0010. So whenever I'm having inward remittance, I'll always buy. Whenever I'm having outward remittance, I'll always sell. So first we are finding for inward remittance. So the rate will be 75.0050 minus 0.0010, 10 paise over here. So it becomes 75.0040. This is my buying rate. But what about sell? Sell is given as 75.0075. So will I take this rate? No. What will I do? I'll add 10 paise to this. So this 10 paise will be added. So what will be my rate for selling? 75.0075 plus 10. So it becomes 75.0085. So I'll be buying at 75.0040 and I'll be selling at 75.0085. Okay. Got it, everyone? Buy at low and selling at high. Correct. Very good. This is always the logic followed. Always buy low and sell high. Okay. Suppose let's say this case. Okay. Now GBP spot GBP is quoted at 1.6 against USD and 3-month forward is quoted at 1.5. Now look at this. GBP is quoted at 1.6 in spot, whereas for forward it's quoted at 1.5. So GBP is in what now? Who can tell me? It is in discount. Why? Because GBP is in numerator. Always remember, it is indirect rate for GBP. So right now it was 1.6. After 3 months it is 1.5. So who is going down? Numerator is going down. If numerator is going down, this GBP becomes at discount. The USD, the other currency, is always at premium. So whenever my GBP goes down, the other currency over here goes up. The value of that other currency goes up. Okay. Now Indian rupee, similar to this. Look at this. Indian rupee is being quoted at, let's say, 48.7069. The 6-month premium being 68.58. Now look at this. If you look at only over here 48.7069, then it means you can't say whether this is in premium or discount because this is a spot rate. But if you look at a 6-month premium, then 68.58, then right side is lower. It means my currency is in discount over here. It means USD is being quoted dearer in forward. Dearer in forward is being quoted at 48.0211. How did I find this 48.02? Look at this. What is the rate? 48.70 for buy. And this is what? Discount. So discount means what? 48.70 minus 68. So it is 48.02. Similarly, 48.69 minus 58. So 48.11. So this is my left side is my buy rate. Right side is my sell rate. So USD is at discount while INR is at premium over here because the rate of the USD is going down. Earlier, today it was 48.70. Later it was 48.02. So it is going down. So USD is going down versus rupee in this case. And in the above case, GBP to dollar we are talking of. USD was in the denominator over here. So in above case, GBP was going at discount. In this case, dollar is going at discount. Okay, USD is at discount. So we'll stop over here today. Those who are watching on YouTube, kindly join the batches, Sankalp batch immediately. Okay, I'll show you how to join it. Okay, how to join the Sankalp batch. I'll show you that. So everyone kindly join this batch. Very important one, huh? Because this free YouTube series, you will be getting it for some time only, not all. Okay, so how to join it? So go to Adda 24/7. Say this. Go to Adda 24/7 over here. Click on JIB and CIB. Okay. Then click on this CIB November 23 now. CIB November 23. Okay. Here you will see all the details. See these batches. English Sankalp batch. Join this batch. Sankalp. Click on this. Okay. Click. Now you will see the details of the batch. The timings of the batch. What are the days? What are the timings? English. Okay. It is a study plan given over here. Right now the study plan is for BFM. Others also will be updated. All the papers are given. All the 4 compulsory papers are covered. Okay. Then look at the fees part. In fact, remember recorded videos are available. So if you miss out on any class, you can definitely get back to it using the recorded videos. Now look at the fees. 80% off it's already given. Prep 80 code is already applied over here. Prep 80. Look at this. If you don't get this discount of Prep 80, use the Prep 80 code and get 80% off. Then click on buy now. You'll see the details. You can enter the code or the code is already applied. You just continue. Put in the details and fill the details. Go to the payment mode. Continue. Make the payment and things are done. In fact, you can join the Mahapack. I would suggest join the Mahapack of CAIIB. This is very important. See the JIB CIB Mahapack on the front page itself. Click on JIB CIB. Click on CIB ka Mahapack. Look at this. In Mahapack, you get 15 plus batches per subject. 15 plus batches. Okay, per subject. Look at this. 15 plus batches for all the 4 subjects. Case study batches. Mock tests are available. Then topic wise ebooks are available. Importantly, remember recorded videos are available here also for each batch. So that is also important for you. Now again the fees part. Look at the fees part. 80% off is already given to you. Prep 80 is already applied. Click on buy now. Click on continue. Put the details. Click on continue. You'll make the payment and join the classes. So definitely join the class, everyone. Those who are watching on YouTube, kindly join it. Tomorrow I'll be back with another class. Okay, till then, bye everyone, and join the class and good night. Okay.